Very good morning in the Mumbai News Center. I'm Sonal Bhutra and you're watching Power Breakfast. Well, those are the top headlines that we are tracking. But before we discuss them in greater detail, let's take a look at what the global markets are doing and specifically what the Asian markets are doing. A weak handover from the Wall Street, which snapped its 5-day winning streak. So largely a red screen as far as Asian markets are concerned. The Taiwanese index is down 0.7%, Hang Seng down 0.4%. And if we look at something like a Nikkei, it is down 1% as we speak. Kospi is down 0.6%. So yes, some profit taking is what we are seeing as far as Asian markets are concerned. The SGX Nifty, as a result of which, is indicating that the start for our own markets could be slightly in the red. It's not a big decline that we are seeing there. It's a 20-point downtick on the SGX Nifty. So let's talk about the US markets now. Wall Street ended Wednesday's trading session lower, with the Dow Jones ending down over 170 points, the S&P closing 31 points lower, and the Nasdaq Composite, the day's underperformer, finishing over 1% lower. And now the big cue from the US. Minutes from the Federal Reserve's July policy meeting signal that the central bank is likely to continue with its restrictive stance until inflation is reined in. CNBC's Steve Leisman filed this report.
The Federal Reserve, after hiking 75 basis points in the July meeting, decided that they would anticipated further rate hikes ahead. They said they needed to move to a restrictive policy. They said it was required for them to meet their policy goals of low unemployment and stable inflation. The pace of future rate hikes, however, was data dependent, and it was a little tricky to read these minutes and get a read on a 50 or 75 from the September minutes, and I'll explain why here in a second. They said it would likely be appropriate to slow the pace of tightening at some point. No indication when that would actually happen. But after the 75 basis point hike, the funds rate was seen by several participants in the range of the long run range of its neutral rate. But some participants thought because inflation remains high, it was still below the shorter run neutral rate, meaning the Fed had more work to do in that regard. Some expected the Fed to hike and maintain the level for some time. We haven't seen that language before, although several Fed officials did sort of talk about that idea, that it was likely the Fed would reach a certain level and stay at that level rather than cutting, which is what the market has priced in now. There was also quite a bit of concern about tightening too much. In fact, many were concerned about that, so that's important. But overall, there were a lot of hawkish talk about inflation. Inflation was seen as unacceptably high and broad-based. And this is interesting. The decline in commodity prices was not seen as enough for the Fed to be comfortable that inflation was coming down. They said it was broad-based, and they said commodity prices can go up, they can go down. They want to see broader-based declines in inflation to be comfortable with that. There was little evidence, they said, of inflation pressures that were subsiding. And they said inflation could stay comfortably high for some time. And just a real quick thing on the economic outlook. They did say the second quarter saw a noticeable slowing, but they did see growth in the second half of this year.
In fact, let us also listen into what Bank of America's Aditya Bhave had to say on the Fed minutes.
I think the language is consistent with our base case for a 50 basis point rate hike. One thing to note is that the minutes are a touch stale, because after the minutes we've gotten, the very strong jobs report, the very strong retail sales report this morning, and the softer than expected July CPI inflation print. So if they really do want to be data dependent going forward, then I think there is a pretty good case to slow down just a little bit.
All right, that's a global market action and opinion. How will these overnight cues impact our own markets? We have our research team joining us today with what the trade setup looks like, the stocks that are likely to be in the news, and the action from the F&O space as well. Hey guys, a very good morning. Reema, let me come across to you first. What is the market setup looking like today?
Well, there is going to be an element of profit booking. We've had a one-way relentless rally over the last 2 months. And this morning, as you pointed out, the SGX Nifty is suggesting that there could be some amount of profit booking, not too much. Just to quickly run you through the big cues, US markets ended lower. So the Dow snapped its 5-day winning streak, ended with cuts of close to about 0.5%. The FOMC minutes show that the Fed officials remain committed to fighting inflation. On the flip side, also, Brent crude prices, which were declining from levels of $100 per barrel down to about $92.5 per barrel, have seen a bit of a rebound. So Brent crude prices have climbed back above $93 per barrel. The FI inflows in the cash markets continues. So yesterday they bought 2,347 crore in cash, while the DII sold 510 crore in cash. And what we've also seen over the last couple of days is that there are many blocks taking place. market levels are elevated. The liquidity in the market is abundant with the FIs also back in the equity markets, in the cash markets. So, PE investors are using this opportunity to actually cash out and perhaps monetize some of their holdings. So today we will have Blackstone, which is looking to sell about 13.5% stake in Sona BLW. And earlier, you remember there was this large 9,000 crore deal which took place in Max Healthcare. So increasingly, we are seeing our private equity players taking advantage of the liquidity as well as the levels in the markets that we're currently at. Today is also the weekly options expiry. This is Thursday, so watch for that. And, we keep talking about how we're marching towards our all-time high levels. The Nifty is now 3.5% away from its all-time high levels. The mid-cap index and the Nifty Bank is 5.5% away from those levels. But it's the small-cap index which is trailing. The small-cap index is still 20% away from its recent peak levels. But all in all, it's been a fantastic run for a market, spectacular. But today, there could be a bit of a pause. The question is, how much do we give up?
A bit of a pause, of course. That's something that we'll be watching out for, Rima. But stay on and also tell us about all the stocks that you're tracking today.
Let me start with Sona BLW, because Blackstone, we understand from sources, is looking to sell its 13.6% stake in Sona BLW via a block deal with which they will be able to raise 4,000 crore rupees. Now, Blackstone held about a 34% stake in Sona BLW. Of that, they're looking to sell about 13% stake. The June TRAI telecom subscriber data was out. This is backdated. This is for the month of June. And the data shows that Jio has added the most subscribers for the third consecutive month. In the month of June, they've added 42 lakh subscribers. Bharti has added nearly 8 lakh subscribers. Vodafone Idea continues to lose subscribers. But bear in mind, this June data gets captured in the Q1 numbers. The Q1 April to June subscriber data, which was out along with the numbers, this data is already captured in it. So in a way, the street already was anticipating these numbers. ONGC has inked a head of agreement with ExxonMobil for deep water exploration in Indian East and West Coast. And finally, Craftsman Automation has commenced commercial operations at its new plant in Pune in Maharashtra. Back to you.
Okay, all right. And with that, let me move on to Nigel, who's joining in with all the cues from the FNO space. Hey, Nigel.
Well, morning, Sonal. The thing that stands out really on one side is the FI flows. You could put all the other negatives on the other side, but the way the FIs are pumping in money, well, that's what's keeping our markets afloat. And everyone's waiting for that correction. But if you get flows like this, 2,000-3,000 crores, we're getting used to that and getting pampered as well. And just take a look at it. In the last 13 odd trading sessions, close to around $3 billion have come in. Consecutive buying, that too being seen out there. The FIs, well, they added long and short positions, 8,000 contracts apiece. On the index options front, well, they bought few more puts than calls. So that's not really a decisive data point they're getting out there. And they wrote index options, both on the call and put side. So pretty much even Stevens on the option side. Now, two strikes, which are most active. The 17,900 put, well, that was fairly active in trade yesterday. Big open interest build up is what we saw. So the sense you get is that there is writing being seen out there. So the 17,800 mark becomes very, very crucial on the downside. 17,800, 17,830. On the upside as well, the 18,000 call, well, that has the highest open interest on the call side. And we saw a big open interest build up out there as well. So that 18,050 odd becomes a bit of a resistance. For today's trade, well, you have a couple of markers that you need to look at. The range is 17,800 to around 18,000 odd. 17,850, that could be a bit of a stop loss for you. How do you approach trade today? Well, the buy on dips thesis is going to be tested today. You have the Nasdaq that ended under some pressure, the SGX Nifty suggesting some bit of red. So the buy on dips thesis could be tested. And remember, for the last many trading sessions, you bought the dip, you made a lot of money. So that's going to be important. The Nifty Bank, yesterday as well, it was a bit of an underperformer in trade. And the last couple of days towards the end of trade, you're seeing, that one, maybe it's moving in for a phase of consolidation after the kind of run that we've seen. So I'll be interested to look at the Nifty Bank as well, because that will give direction to our own markets. For starters, the SGX Nifty, well, it's suggesting some bit of red to kickstart trade. So let's see whether or not the 20, 30 point dip, if you get a 50, 60 point dip, maybe that gets bought into and risk reward could be favorable. Back to you.
All right, okay. Nigel and Reema, thanks a lot for joining us and prepping us up for this trading day ahead. With that, we'll slip into a break now, but a quick reminder for our viewers, it's that time of the year again. Money Control Pro's Financial Freedom offer is back with added benefits. Get a Money Control Pro subscription at net zero cost by claiming exciting offers worth 1,500 rupees from our partner brands. Grab the benefits now only on the Money Control app or the website. In an effort to boost credit flow to the agriculture and MSME sectors, the Union Cabinet has restored the interest subvention of 1.5% for agriculture loans up to 3 lakh rupees and enhancing the ECLGS to 5 lakh crore rupees. Sapna Das is joining us with all those details. Sapna?
Well, on the ECLGS front, the announcements have already come in the budget, not just in terms of extension of the scheme till the end of the financial year, but the additional 50,000 crores worth of enhanced limits. So, nothing new in that except that the cabinet has now approved that and the scheme will now roll out. Roughly around 6 to 7 odd months remain for the financial to be over. So it remains to be seen what is the offtake in terms of loans for the hospitality sector, which is what this 50,000 crores will try to target. That's one. Second, even if you look at the numbers in terms of the ECLGS, the sanctions, they are a mere 3.67 odd lakh crores against an enhanced limit of 5 lakh odd crores, which means that there is enough headroom available, for approvals as well as for sanctions and for disbursements. So it remains to be seen. Maybe the next budget will give another extension to the scheme if that is required at all. That's one. Second, of course, in terms of the interest subvention for small ticket agri loans up to 3 lakh odd rupees, the government has restored this subvention simply because overall interest rates have gone up. RBI has done almost 4 rate hikes and there is enhanced inflation. So to take care of all those concerns, this interest subvention has come. It won't be much of a hit on the exchequer, around 7.5 odd thousand crores a year. It pans out over the next 3 years. So that is what the cabinet has cleared in terms of the important economic announcements.
Sapna, thanks a lot for joining us with all those details from cabinet to the central bank now. The RBI has released a discussion paper on aspects related to charges in payment systems and various payment instruments. My colleague Ritu Singh is joining us now on the phone line with more details on the same. Hey Ritu, good morning.
Good morning, Sonal. The key takeaway from this paper is that at the end of the day, it is just asking questions on various charges and how they're levied, but RBI has not taken any stance. It has invited suggestions and feedback on the paper by 3rd of October. Perhaps after that, we'll see RBI come out with a more clear policy on what these charges should be. The broader theme is whether digital payment charges should be market determined or, they should be independent of the transaction value and what more transparency can be brought in. So, for instance, on specific charges, RBI says if IMPS or your, real-time gross transfers, should rates on that be market-driven or should RBI prescribe those? If debit card charges should be regulated as well, and whether RuPay be treated differently from other cards when it comes to MDR rates to promote, RuPay. The other question it asks is, will it be more effective, one, to either waive or reduce the MDR charges, or two, to give incentive to card holders when it comes to increasing the use of digital payments? Importantly, it also asks if the zero cost for MDR for UPI should be done away with, and if subsidizing cost will be a more effective alternative to zero charges for UPI, and whether that, if imposed, should be a percentage of the transaction value. So these are some of the key questions that the paper raises. But like I said, no stance has been taken yet. Either way, it seems like RBI is moving towards some sort of regulation on these charges, but it is unlikely that they will be made very high for users because at the end of the day, both the RBI and the government want digital adoption to go up.
Okay, interesting. Ritu, thanks a lot for joining us and giving us all those details. Let's talk about the retail sales data now. High inflation has not dampened consumer sentiment as initially feared. Retailers across the country recorded healthy sales in July with an 18% growth over the same period before the pandemic. Shilpa Ranipeta has all those details. Shilpa.
Well, there is a visible recovery in retail sales as consumers are now returning to shop at malls and stores as they did before the COVID-19 pandemic. Now, according to the latest data from Retailers Association of India, retail sales in July increased 36% compared to July last year, while they were up 18% over the pre-pandemic levels of July 2019. Now, it's important to note, though, that July last year, the country was still coming out of a severe COVID wave where the sales were still much lower. Now, from a category point of view, quick service restaurant sales were up about 17% over pre-pandemic levels, and this growth is something that QSR players like Jubilant Foods have also been referring to. Now, beauty and personal care sales are still slightly lower compared to pre-pandemic levels at 3%, and the categories that are actually showing most traction are apparel and clothing and footwear sales, both of which were up above over 20% compared to 2019 and nearly 50% more compared to last year. Now, a good recovery is also being seen in food and grocery sales, in consumer durables and electrical sales, and also in jewelry sales. Now, while there may be some sections like personal care that are yet to recover fully and the impact of inflation is still a cause of worry, RAI says that the July numbers and the trend of recovery has retailers upbeat about the upcoming festive season. In fact, we also spoke to companies like Parle Products, V-Mart and Bajaj Electricals. Listen into what they had to say about a recovery, not just in demand, but also in sales.
There is a recovery, there is some recovery, but still we are missing out the pre-COVID numbers. And I think things will get in control. Things are becoming better. People are becoming normal with the situation. There is an anxiety that definitely every household, which is the common household, which earns between 15,000 rupees to 40,000 rupees, has in terms of their savings and their management of their budget in their house. So there is a pain which is there.
One, even in volume terms, if I compare to the last 1, 2 or 3 years, has been better. Maybe it's partly because of summer. We've had a good summer, after 2 lockdowns, but even compared to pre-COVID. So I just think slightly better on volumes. On actual value terms, of course, it's better.
You've seen a very strong revival in demand in the first 6 weeks. Last quarter, as you rightly said, was flattish as far as volumes are concerned. And whatever growth we saw was primarily driven by price hikes. So growth was, price-led and not really volume-driven.
Welcome back. You're still tuned into Power Breakfast on CNBC-TV18, and it's time to talk commodities now. Manisha Gupta is joining us with all the update. Hey, Manisha, good morning.
Morning, and it's quite a choppy market continuing as the markets are reacting to the U.S. Fed meeting minutes yesterday. But I want to start with the crude oil prices, which are off their lows, by the way. The EIA data is something to keep an eye on, which has shown a draw in the U.S. inventories by 7.1 billion barrels. This is much higher than what the street was anticipating. And apart from that, you also have seen the U.S. gasoline stocks also decline for a second straight week. The gasoline production itself has averaged 10 million as compared to 10.2 million in the previous week. So lower output, weaker inventories, and the demand really picking up seems to be supporting the crude oil prices right now. But that is just about U.S. because when you look at the Chinese numbers, the import and the demand is weaker on that side. And then the markets are looking at higher supplies as well, whether it is from Saudi Arabia or Russia as well, where it says that the output is increasing and the earnings from energy exports is estimated up by 38% in this year as compared to the previous year. So as of now, the market's really looking at matching demand and supply numbers as we see, and is the reason we are trading in the positive for a second straight day for crude prices.
Okay, second continuous day of positivity as far as crude markets are concerned. Manisha, thank you so much for joining us and giving us that update. Quickly taking a look at what the Asian markets are doing. They are still in the red, largely in the red. In fact, we have Nikkei sitting with cuts of 0.8%, mild recovery from the low, so to say, but still it's a deep red. On the Taiwanese index, which is down around 1%, the Hang Seng is down another 0.3%. Remember, the US market snapped their 5-day winning streak, so some impact on Asian markets as well. SGX Nifty, as a result of which, is indicating that start for our own markets could be in the red, but it's a mild downtick. A 19-point downtick is what the SGX Nifty is indicating. Let's see which way things go, because it is also the weekly options expiry day, so the last 1 hour of trading will be very interesting. Now we'll take your leave on this edition of Power Breakfast. Do stay tuned. All the market action on Bazaar Morning Call.